Good afternoon. Welcome to the mortgage market update for today, March 13th, 2023. Now, I know I'm getting a lot of calls. There's a lot going on in the market. People want to know what's going on. And here's the bottom line. The mortgage market, this is actually a good thing for us. You're going to see rates come down this year. You're going to see 2023 is going to be a much better year than expected because of everything that's going on in the market right now. So I'm going to not be super technical to you on this page. If you want the more technical version, if you're a real estate agent, check out the Empower You YouTube channel or the Empower You Agent Facebook page. I have a 20-minute version of this there where we go into a lot more detail about what's going on. I didn't want to be so technical on this side. So feel free to do that. I want to share my screen and go over some of this with you today. So first thing we're going to do is get some backstory. So you know this, in 2020, 2021, you saw mortgage rates fall into the 2s and into the 3s. So that's not a surprise to you. And because of COVID, we had the bailouts. We had the stimulus packages, as they called them. And the government was basically printing money. And I told you back then, you can't have these kinds of stimulus packages and bailouts without it coming at a cost. And the cost was inflation. And this was something we told you was coming. And then in 2021 and 2022, you saw the inflation hit. While this was happening, our federal government, the Fed, they kept saying, it's okay, inflation is transitory, it's going to go away. But I kept saying that's not the case. This isn't going to go away because we have to pay for all this spending. And in June of 2022, you saw inflation hit 9.2%. That was the top that it hit. And, it's not a surprise at this point. Now, when that happened, though, the federal government finally realized that transitory was not inflation, or inflation was not transitory, and they started to raise the federal funds rate to lower inflation. And this was something that they needed to do, but they waited too long to do it. But then when they started doing it, they did it too fast, too quickly, with crazy increases. In a 4.5-month period, we saw the federal government raise the federal funds rate 30 basis points. That's equivalent to 3%. 3% in 4.5 months. That was a lot. And in a 7.5-month period, you saw it raise 3.75%, so 375 basis points. It was a lot in a short amount of time. Overall, we are currently sitting at a Fed funds of 450 basis points, which is 4.5% currently. Now, in January of this year, you saw mortgage rates fall. We hit into the 7s in November, but by January and at the beginning of February, we saw them, falling. Actually, February 2nd, rates were touching down into the mid to low 6s. This was great. You saw the economy start turning. You saw people buying houses, locking in their rates. The mortgage market and the real estate market started to really pick up. But on February 3rd, our world changed when the job report hit. And that's because we were expecting 188,000 jobs, and we got 570. Now, first off, the jobs report was not totally accurate, but we're going to forget that for now. The big deal was this blew open the door for investors to be saying to the Fed, hey, you're raising the Fed rates here. You're not solving the problem. You got to raise it faster and higher. And that was not a good situation, because the Fed came out last week. General Chairman Powell came out saying that at the March 22nd meeting that they were planning to raise the federal funds rate. It used to be a quarter of 25 basis points. Now they were planning to raise it 50 basis points. So 0.5%. And then all the bank collapses started to happen. So this was the Fed, though. The Fed's like, we're going to fight inflation. This is the tool we have to do it. And we need to slow down this economy. We need to hurt the job market, because the only way to slow down the economy is to hurt the job market. And when the jobs report comes out so high, it's telling the Fed that, hey, you're not doing enough. We need to do more. The problem is, if you have a patient, if you're a doctor and you have a patient and you're giving them medicine, right? You give them some medicine to make them better. But 5 minutes into it, 5 minutes after you give them the medicine, they're not better. So you give them another dose of medicine. And then 5 minutes later, again, they're still not better. So you give them another dose and another dose and another dose. And before you know it, you overdose the patient and they die, right? It's the same thing in our market. The Fed has been overdosing the economy with these rate hikes, not realizing what they were doing. You see most economic indicators like the jobs report, the consumer price index, all that is lagging indicators. And the Fed doesn't have that in their head. They're getting a number and thinking, oh, jobs are up. Well, jobs report is a lagging indicator. Inflation, lagging indicator. You're 30, 60 days behind on some of these reports. So they're not realizing that stuff they did 60 days ago hasn't necessarily taken effect yet. So that's the problem. Now, you need to realize in the short term foundation here, when the Fed raises the federal funds rate, you're going to see mortgages go up in the short term, okay? And that's exactly what happened. Mortgage rates went to 7% last week. They were in the sevens. And investors are saying, hey, you need to raise the federal funds rate more to offset these job reports. So that's part of the problem that we hit. Now, I want to try to put this in a perspective for you. So I'm going to show you something. And this is the exact same thing we've been going over with our son, Grayson, 9 years old. And this is what we're trying to get him to understand. Let's say Rebecca, I lend my son, Grayson, $100,000 at 3% interest. Okay. Lucky kid, right? So I lend him $100,000 at 3% interest. How much in dollar form is Grayson going to pay me in interest this year? The answer is $3,000, 3% of $100,000. Now, what if next year the rates went to 6%, right? 6%, they doubled. Is the loan that I'm holding with Grayson still worth $100,000? How much more would I have to, I'm sorry, I just had something start in the background. How much more would I have to invest to earn that same $3,000 in a 6% environment? And the answer is $50,000. I would have to invest $50,000 in a 6% market to earn $3,000, where last year I'm investing $100,000 in a 3% market to earn $3,000. So is my loan still worth $100,000? If I sold it today, would I get $100,000? No, because you're not going to buy it from me at $100,000 earning 3%. You're going to take your money and go invest it in something else that's yielding a higher rate of return, right? So my loan is worth half of what it used to if I would sell it. Now imagine a bank with $100 billion in investments. That's what they're running into. The investments that they bought the past couple of years are not worth what they used to be worth. Now, I'm not going to get into all the technicals of this, but that's the problem. They're not earning what they could be earning in other areas. And this is getting noticed. And as it got noticed, people started to short the bank stocks, like Silicon Valley Bank. They started to short it. And just when they started shorting it, it only drew more attention to it. And then people are going, hey, you have your money in SVB, go get your money out before there's nothing left. So there was this big run on the bank. And they didn't have the money to pay all these depositors out. The FDIC insures them, but they only insure up to $250,000 per account. Now, Janet Yellen's on the news on Sunday saying there will be no bailout for the bank. It is going to fall. You will lose your money. But the problem was you had companies like Roku that had $500 million in deposits there. You had CEOs of tech companies that had $10 million there, and the money's all gone. So an hour after Janet Yellen's on the news saying this, the Fed, stepped in, and they actually said they're going to bail out everybody. They're going to give everybody their deposits back. And as they do this, they also decided that they were going to let the banks, I'm trying to get everything here. They were going to let the banks sell back their underwater securities back to the federal government for the face value. So that would be like me sending this $100,000 loan I have with Grayson to the Fed to be paid $100,000 when I could only sell it on the market for $50,000. So they're letting banks do this. It's called the Bank Term Funding Program. So that's what's happening right now. But I want to leave you with this. This is the current bond market. And we subscribe to MBS Highway. They give us a lot of great, useful information that I can regurgitate to you. And this is where I track to find out what's going on in the market. So right here is February 2nd. We were doing well. Rates had gotten better. And then you saw right here on the 3rd, you saw that jobs report come out. And ever since then, it was this big line down where we saw rates get worse. Now today, we're over here. So we actually have ridden this back up. We are testing this 50-day moving average right here. So things are doing well. And what does this mean for you, right? And what it means for you is 2023 for the mortgage market is going to be good. It's going to be better than we expected it to be before all of this happened. Deflation, or we're going to see deflationary measures happen. You're going to see inflation come back down with this because the Fed has no choice. They cannot keep raising the federal funds rate. They have to actually keep it the same or lower it to get us out of the situation we're in. So you're going to see inflation come down. You're going to see mortgage rates come down. The stock market's not going to do so well. It's going to take a hit from this due to uncertainty. But, sometimes things have to happen. So if you have any questions about this and what's going on, please don't hesitate to reach out to us at the Rebecca Foote Mortgage Team. We are here to help you and let us know what questions you have. I hope you have a great rest of the day.